I challenge you to compete in this simulated investing tournament to win some serious money. I hope you'll join us. I'll be coaching you every step of the way.
I wanted to call out QT briefly because recall that the month of September is the month that the QT runoff schedule was set to double from $47.5 billion a month in balance sheet reduction to $95 billion a month. So I went back and looked at the first 2 weeks of September, and just based on the new pace of runoff, those should be down by $47.5 billion. But if you look at the trends, they ended August at $8.406 trillion, and as of mid-September, they're actually at $8.407 trillion. So instead of going down by $47.5 billion, they've actually gone up by $1 billion. So again, all of this backdrop is happening in spite of QT running clearly well below the rate it's supposed to be running at from a, if you will, runoff standpoint. So,
what is the runoff right now on Fed? What was the latest number?
Yeah, well, it's sort of the opposite of runoff. They actually increased their holdings of securities by a billion month to date in September, and they should have taken it down by $47.5 billion in the first 2 weeks of September. So, we'll see what the next 2 weeks bring. But yeah, they're running sort of way behind schedule at this point. I mean, you add this up to the previous 3 months where they should have been down, to the tune of 120 billion, and they're down less than half that. So, yeah, it's kind of getting to a point where it's sort of getting interesting, and the question starts to become, what is their plan if they're not coming anywhere close to these numbers that they're supposed to be committed to.
At what point is that? I mean, that's basically a lie, right? Like you're telling Americans that you're doing quantitative tightening, but you're easing.
Yeah, I think I read, the only thing I've sort of come across that's interesting is I read somewhere, and it kind of makes sense, that the mortgage book that they're sitting on, most of that was originated back in the environment, or acquired, I should say, back in the environment when 30-year mortgage rates were down around 2.5% to 3%. And you fast forward to today, and they're at 6%. And so, the problem is there's basically no prepayment in the portfolio, right? So it's not running off the way that, you would normally expect it to, because of obviously what they themselves are doing from a rate standpoint. So, that I think is an element of the challenge, but nevertheless, they're going to have to, I guess, figure out a way to effectively facilitate, the runoff that they had told everybody to expect. So one way or another.
It's probably the most important thing that's been said on the call so far this morning from a macro perspective. Really, I mean, that's what interest rates did without quantitative tightening last week, or in the last month. I mean, we got the 2-year yield that's testing 4% right now. And that's with nowhere close to even half of what they're supposed to be doing. This whole consensus establishment world just hangs their hat on what the Fed thinks, or what the Fed thinks is going to happen. That's really sad and pathetic on a lot of levels, and that's being polite. But for them to get away with actually not even doing QT so far, and telling the whole world that they are, and it is, I don't know, it's just un-American. It's a lie.
If this goes on, sort of long enough, I guess, it does start to raise the question whether they're going to have to actually, God forbid, sell some securities as opposed to just allowing them to run down, right? Just sort of natural prepayment maturity. So that, I think, is kind of an interesting question that at least I'm starting to think about.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.